The Money Show.
Investment School.
Investment School Director at Rand Swiss, Gary Booysen, with us this evening. And Gary, you want to talk about navigating currency volatility. I've changed the subject. I hope you don't mind. It's the subject is how to ride the currency bucking bronco. It's the same topic. It's just a slightly different way of expressing what is an astonishingly difficult thing to do.
No, it's an astonishingly difficult thing to do, but it's also incredibly important for, I think, private citizens, but mostly all businesses, so large businesses, SMMEs. You know, when you get the currency doing what we've seen, in the last week or so, it has a material impact on the underlying operations of so many businesses, and so many of these risks could have been avoided if that had been identified and if the businesses had put a little bit of protection in place.
Okay, so talk to me then about the broad trend in currency. What we've seen over the last 20 years, we have seen the currency ebb and flow. I think that's the best way of putting it. And in some cases, ebbing and flowing back to stronger than when it was. But there has been a gradual, and it's been a slow melting, a slow burn of continuous devaluation over time. Of that, there is absolutely no fear of contradiction.
I'm going to contradict you now.
Okay.
No, also remember, it's easy, especially as a layman, looking at a currency chart and saying, oh, look, the currency is weakened against the US dollar over a period of time. That must be because we have load shedding and our economy is terrible. But the fact is that there's obviously the interest differential and the inflation differential to take into account as well. When you go and park your currency in dollars, you're not generating any sort of return, or in the past you haven't. Obviously, with the Fed lifting interest rates now, you are starting to generate a return, but in South Africa, obviously our interest rates are a lot higher. Our inflation picture is a lot higher. Generally, we have a slightly real interest rate, a positive real interest rate, whereas a lot of developed markets have a slightly negative real interest rate. When I talk about real interest rate, it's just inflation minus the nominal rate that you're getting. But yes, absolutely, the South African rand obviously has depreciated. I think we've seen a deterioration in the fundamentals in South Africa, but that's not the whole picture. You've got to factor in that you would have had a higher return had you had a cash deposit in South African rand versus a dollar.
Fair enough. However, if we look at it, on the 1st of March 1995, the rand-dollar exchange rate was 3 Rand 58. So that's 1995. Our first sort of significant blowout sort of peaks in December 2001, and the rand has gone from 358 in 6 years all the way to about 1164 or thereabouts. It then recovers to about April 2005, and we traded 6 Rand, between 6 and 7 to the dollar for ages, between 2004 and sort of 2007. Then the global financial crisis happens, but then there's a sharp recovery, and the currency comes all the way back down into the 6 Rand 50 to 7 Rand level again. It blows out again until Jacob Zuma disappears. To 1538, and it comes all the way back down to 1250, and then blows out again in COVID, and then recovers, and then blows out again. But generally, I mean, the rand you have in your bank account buys you fewer dollars. I get that you could have earned a higher return on in terms of interest or in terms of investments in South Africa, but if your salary has increased by inflation in South Africa, I wonder whether or not it's kept up in global dollar terms. I don't think it has.
No, I don't think it has either. And you're absolutely right. And with those big kind of broader trends that you've just described, at the moment it feels like we're in one of those big ebbs. The tide has just if you want to put it that way, gone out, and you kind of look at your salary
and your costume, your baggies. You forgot to tie a knot.
Yeah, South Africa definitely forgot to put on the swimming costume. That's for sure.
You put the costume on, but it was undone. And as the current went out, it took your costume off with it, and you're standing now with in your knees, and you don't realize you're standing knee deep in the water, and you're not wearing anything.
100%, and that's a difficult place to be because you don't have a costume. So, I think the one thing that I don't know if I can continue the metaphor, but
no, please don't.
I think the one thing that many listeners need to appreciate as well is that with what we've seen in the last week, and kind of all the speculation around Lady R and what's happening, this does seem like a knee-jerk reaction. So if you look at the currency over a long period of time, it generally does fluctuate around what's called the purchasing power parity. So the easiest way to think about that, the Economist used to publish something called the Big Mac Index, and it would compare how much does a Big Mac cost in New York and how much in Paris and how much in South Africa. And the idea was that all Big Macs are essentially fungible, which means they're all essentially the same, and they should more or less be equal in every country, and by that you can gauge whether a country, if the Big Mac is very expensive and in another country the Big Mac is very cheap, that's when you'd know, if it's very cheap in a country, that currency is perhaps too weak, and if it's too strong, that currency is perhaps too strong, and that's kind of the easiest way to think about purchasing power parity. And what you've got, most economic models have the currency fluctuating around that point, and absolutely, we have lost in terms of purchasing power parity over time, and our currency has weakened, but it does have those big fluctuations that you're talking about around that midpoint. Now, I've seen estimates from big economic houses saying that they see the purchasing power parity midpoint of the South African currency at the moment at 16 Rand 50 to the dollar. We're trading 19.10 this morning, and that's after a big recovery from the 1951 that we saw on Friday. So I think if you're standing there without the swimming costume on, just be very careful. Be very, very careful to say, this is it. We're the next Zimbabwean dollar, or we're the next Turkish lira. Just take your money out, try and hedge at this stage, run for the hills kind of thing. I think just be very careful because the South African, there's many things that will aid in the devaluation of a currency. And if we look in Turkey's case, for example, it was really their central bank. They had high inflation, and instead of raising interest rates like, typical economic theory would have suggested, they decided to cut interest rates, and we saw a massive devaluation of the lira in that situation. I think South Africa is very different. Our Reserve Bank is a very strong institution, arguably one of the strongest institutions that we have in South Africa.
And it's really important to explore this, Gary, because people don't like the fact that Lesitja shouts at MPC meetings. They don't like that he shouts. But the point is, I think he's so driven so mad and so frustrated by a lack of support for the economy within the political sphere that as the consummate professional that he is as governor of the Reserve Bank, his frustration, I think, must be deep and palpable, and he is very clear on the mission to raise interest rates, and he understands that it hurts people. He knows this is not a malicious act. It is a case of trying to protect the buying power of the currency, and it is a thankless task in an environment where, other than National Treasury and SARS, perhaps, there doesn't seem to be a broad appreciation of the delicacy of an economic ecosystem.
Absolutely. And of course, raising interest rates and making capital more expensive is very painful in the short term. Anyone that has debt at the moment is feeling that. And if you do the calculations on how much more your house is going to cost just because of a 25 basis point or 50 basis point increase in the rate, it's eye-watering. It really does change the picture for you. But the alternative in the medium to long term is absolutely catastrophic. And that is what he is trying to protect. So, I've got to agree with you. I mean, it's a very thankless job, but it's a very, very necessary one that is being performed currently.
Other than hoping for, a £10 note from a family member living in another country, or a $10 note that you put under your pillow for a rainy day, how does one protect oneself against currency calamity? I mean, it's, again, possibly too late in this particular cycle, but as we become wiser and things hopefully improve just a little bit, how should we be thinking about the problem?
I think there's an important distinction to make when you're looking at your exposure and your risk around currency as well. So you basically get transactional risk and you get translational risk. Now the easy way to understand that is a transactional risk is, if you're doing business and there's a time lag between when you enter into a contract and when you have to deliver on that contract. So, the risk for you then in currency is, I promised someone X amount of dollars and I don't have dollars yet, and then suddenly the rate changes and you're penalized. Now that risk is very important, even at these levels, to try and hedge that, because it brings certainty into a business. That's the transactional risk, when you're performing a transaction and there's a time delay. The other type of risk is really it's a translational currency risk, and that's just the converting of your financial results. So, if you were fortunate enough to take money out of the country and go and park it overseas in an investment vehicle, you bought your Vanguard S&P 500 tracker, you're currently sitting on a big translational profit. Now, it's easy to look at that and say, oh, well, I was so clever.
Because your Vanguard S&P 500 tracker is not done spectacularly, depending on when you bought it. Of course. There was a big recovery from the COVID crash, and then it kind of just went sideways and slowly down, and then sometimes more quickly down. It's not the be all and end all, is it?
No, absolutely not. I was merely using that as an example. You could have bought a house in the UK, which probably also didn't do too great. You could have bought any number of assets, but that are international assets that don't have a rand base. And even that Vanguard tracker, as you say, it might be down 10-15% from where you bought it if you were buying it at the peak of the recovery after COVID. If you then convert that back to rand because of the blowout in the currency, suddenly you've got a positive rand-based return. So you kind of may be feeling clever about the jurisdiction that you chose. But the fact is that's just a translational gain, and when if you are highlighting, let's say, the Vanguard S&P tracker as your desired destination of an investment, or you've decided to buy a house in Greece, or wherever you've decided to and however you've decided to internationalize the money, that translational gain is very temporary, because unless you're planning on selling the house and bringing the money back, or selling your offshore investment and bringing it back now, you're not actually going to realize that gain. And all that's going to happen is when the tide comes back in, you're going to, I suppose, have time to put your costume back on. I don't know. But essentially that is going to fluctuate all the time. And, it is a little bit, unfair sometimes to investment managers as well. You get very bad money managers that get the big currency benefit. And it does, to an extent, obscure performance. And I think if you're investing internationally and you're trying to protect yourself from these kinds of risks, you've got to be cognizant of what you're investing in and try and measure based on the territory that you're in, and try and take out as much of that translational currency performance as you can to try and get a fair estimation of what you've invested in. But I suppose the question is, how do you hedge this? How do you manage this stuff? And there's many ways to do this. The kind of typical way that everyone thinks about is using their offshore allowances. So the single discretionary allowance, take your $1 million out every year if you can. You can always go, these days it's called an approval international transfer PIN that you would go and get once you've done your foreign tax clearance certificate. And you can go and take your 10 million rand out, and that's then free. You essentially cross the South African border with your capital. You can go and invest in whatever you want. You never have to bring that money back to South Africa. But that really isn't the only way to protect yourself against currency movements. And, obviously, on the local exchange, we have fantastic businesses like things like Richemont, for example, that while you're not you're buying through a local exchange, you have exposure to currency protection. If the rand was to blow out, you're obviously going to take the ride up. We were talking about the S&P 500 tracker earlier. There's a wonderful product done by Signia, for example, that are local ETFs that trade on our local exchange that will give you all that currency protection as well without having to take it out. Now, why is that important? Because not everyone has those allowances. Yes, all private, kind of individuals have those allowances if you're a South African tax resident, but trusts don't have it. South African companies don't have foreign investment allowances. So the only way for them to protect themselves is really to either use an asset swap or, kind of other mechanisms. Now, those products suddenly become very interesting for those types of vehicles. So that's one way of doing it. And then, of course, you can actually use derivative contracts as well. So you can book forward cover. If you're doing a transaction and you need to pay in 6 months' time, you can essentially lock in your rate for 6 months down the line now, and essentially do the transaction, lock in your currency, and when it comes time to pay your supplier, you'll have exactly how many dollars or pounds or euros or whatever you needed. At the same time, if you're just a private citizen and you kind of want to get a little bit of a hedge in place, there are many trading instruments that will offer you protection at a fraction of the cost that you would get by actually physically moving cash across the border, which comes with all the associated costs around the spread, which can be up to 1.5% at some institutions. So you can do that at a fraction of the cost by using proxy instruments as well. So there are a lot of ways to do this, and it really depends, I suppose, on the listener's individual situation.
No, absolutely, and this is stuff for grown-ups. It really is, and the strategies for doing it. And I mean, and again, many South Africans simply don't have the luxury of a plan B. For those with a plan B, they're almost double cursed because they're second guessing themselves, they're second guessing their domicile, they're second guessing where their capital should be. If you are somebody who is in South Africa for the long haul, you need to be protecting yourself against the vagaries of the domestic economy, the fluctuations in the currency as best you can, and that is where you go for a domestic strategy with offshore exposure. You don't have to go through the contortion. And look, I mean, R1 million a year for 99% of people, I think, is an awful lot of money. So it's all well and good for us. Oh, yes, no, we take $1 million out a year, and then occasionally we take off the 10 million each, and then we can't wait for the kids to get to 18, because then they can take 10 each. Oh, not everybody's in that ballpark here, Gary, but the idea of being sensible and diversifying one's approach to investing and not putting it all into just the Satrix 40, although most of the Satrix 40 gives you the protection that you were referring to earlier with the mining companies and the Richemonts and the Naspers and the processors, for example.
Yeah, absolutely, and I think that's a great point as well. So, I think the one message maybe I would like to leave with listeners is that you also should try and avoid the real negative kind of fear-mongering that goes on. The idea that, the South African Reserve Bank is trying to shut down your offshore allowance, and this is the last time you're going to be able to exit currency from the country. Think about exactly what you just said. For most people, you don't even need to do a tax clearance, and even that, it takes about 5 days. It's not complicated to get your 10 million rand allowance, but for the vast majority of people, there are no exchange controls in South Africa. So the kind of fear-mongering that people are going to lock you into South Africa, I mean, you need to take that with a pinch of salt, especially after the currency has blown out. And even if you are looking at kind of, small hedges, and typically if you are planning on staying in South Africa longer term, you're 100% right. You do need to have some sort of offshore protection as well. Because think about it, even though you might be living here, you still consume a lot of international products. You still buy TVs that are shipped in from overseas. Anything imported is going to go up with a weakening currency. And to have some of your savings sitting in, we call them FCA accounts for private citizens, so it's just a foreign currency account, you can literally just park a residual balance of dollars, and it doesn't have to be big. I think the accounts start at, I think to get the full interest rate, which you can get above 3% on dollars now, you need to have $10,000 in the account as kind of your nest egg. Now, if you got your emergency fund in Rand and it's only sitting in Rand, just converting a portion of that or even the majority of that into a dollar-based investment is often not a bad idea. Again, with all the caveats of, you need to look at the person's personal situation, but definitely something to think about.
Gary Booysen, thank you very, very much indeed. Gary Booysen, a director at Rand Swiss.